Typical trend traders have only 3 consecutive goals in mind: identify new potential long-term trends, stay invested in clear strong trends as long as possible, and close positions as quickly as possible when it's clear that the trend has ended. Thus, the purpose of a trend following strategy is not to predict tops or bottoms. The typical trend trader will try to identify the main trend and then open a position in the direction of that prevailing trend in order to maximize potential profits. In this video, you will learn about the different type of trends, how to recognize them, how to use them, how to open positions in the direction of the main trend, and how to find the best trend following trading setups using ChartMill. The content in this video is also covered in an article on our website, and I'll put a link in the description below. My name is Christoph. Welcome to ChartMill. Let's start with a distinction between the different types of trends. Regardless of which chart or time frame you look at, there are only 3 possible trend formations: a rising trend, characterized by higher tops and bottoms, a downward trend, characterized by lower tops and bottoms, and finally a sideways trend, where the tops and bottoms are at approximately the same level, whereby price is moving up and down between a certain price range. Now, it's important to understand that each and every trend is only valid on the time frame on which it is visible. It is perfectly possible that based on the daily chart you are dealing with a rising trend, but that the current trend on the monthly chart is still overwhelmingly bearish. Because it makes sense for a trend following strategy to take action based on a prevailing trend, it is important to be able to determine the trend of a stock as accurately as possible. And this can be done in several ways. The most obvious and simplest way is to take a good look at the chart. Clear upward and downward trends are easily recognized by the sequence of higher tops and bottoms in a positive trend and lower tops and bottoms in a negative trend. However, these kind of perfect price trends rarely occur. Rather, you will be confronted with charts like this. A much more erratic price pattern, but when you compare the price on the left with the price on the far right, there is indeed a rising price trend. So a more systematic and objective way of determining the trend is needed. Using moving averages is the most popular and also the most appropriate way to determine the trend of a stock, both in the short, medium and long term. A moving average is a technical indicator that adds up the price points of an instrument over a period of time and then divides it by the number of points, creating a single trend line. The moving average is popular because it helps determine the direction of the current trend and reduces the influence of random spikes. Calculating a moving average requires a certain, sometimes significant amount of data, depending on the chosen length of the moving average. A simple moving average of 10 periods requires data of 10 days, while a moving average of 100 periods requires data of 100 days, assuming that one period is one trading day. Bear in mind that that same SMA 100 can cover either 100 days, 100 weeks or just 100 hours. It all depends on the time frame you are looking at. Some commonly used moving averages are the SMA 200, the SMA 50, the SMA 20 and the SMA 10. The SMA 200 represents the average price of the past 200 trading days and is therefore widely used for determining the long-term trend. Stocks whose price is above the 200 SMA on the daily chart are considered bullish, and if the price is below that same 200 SMA, it is a sign that the stock is in a downward trend or bearish. The SMA 20 and SMA 50 are used to determine the medium-term price trend. If the SMA 20 is above the SMA 50, the medium term is bullish. The same medium term is bearish if the SMA 20 quotes below the SMA 50. To identify the short-term trend, the combination of the SMA 10 with the SMA 20 can be used. If the SMA 10 is lower than the SMA 20, the short-term trend is downward, and otherwise the short-term trend is bullish. More in-depth info about moving average can be found in these articles on our website, and links are put in the description below. The ChartMill trend indicator is a 30-week moving average line used on the weekly chart, so each bar or candlestick thus represents a full trading week. It serves to visualize the long-term trend of a stock. The line can be red, green or gray, and red is bearish, green is bullish and gray is neutral or a sideways trend. The advantage of this indicator is that a single line can represent the different long-term trend stages. And this 30-week average line is also discussed in the book Secrets for Profiting in Bull and Bear Markets by Stan Weinstein, a technical analyst and trader. Specific technical indicators can also be used to determine the trend of a stock. Let's take a look at the moving average convergence divergence indicator. For determining the short to medium term trend, if the MACD, the red line, is below the signal line, the black line, the trend is down, and if the MACD is above the signal line, the short-term trend is bullish. For the long-term trend, we consider the position of the MACD and signal line in relation to the zero line. If they are both below the zero line, the long-term trend is downward, and if both the MACD and signal line are above the zero line, the long-term trend is bullish. In a trend-following strategy, positions are only taken in the direction of the existing long-term trend. Determining the time frame on which you trade plays an important role because, as we touched on earlier, the observed price trend depends purely on the time frame on which the stock is being viewed. This is a daily chart showing the SMA 200. Since the price is still trading above that SMA 200, the trend remains positive. If we take a closer look at the same stock on the hourly chart with the same SMA 200, we suddenly notice that the price is below that blue line, indicating that the long-term trend on this hourly chart is downwards. Another example, but now on the daily and weekly chart using the ChartMill trend indicator. As seen on this weekly chart, the current price level is above the ChartMill trend indicator, which means that the long-term trend is upwards. However, on the daily chart, price is already below that same line, indicating a downward trend. The top-down approach ensures that the decision we are about to make to buy or sell a stock is based on a system that determines the trend as objectively as possible. This means that we always rely on the higher time frame to determine the main trend. Take a look at the following chart. Price starts at the bottom left and ends at the top right. A beautiful upward price trend. And it is very tempting to imagine how much money you would have made if you had bought at those low price levels. The real question is, what you're going to do if you notice a chart like this one. At first glance, this looks like a price retracement in a new bullish trend with the formation of a second higher low since the last price bottom, which dates back to mid-May 2020. Also, the position of the SMA 20, which crossed the SMA 50 upwards in early May, is an additional indication of a new bullish price trend. A price decline near the 50 SMA, as visible on the chart, could well be the ideal entry point to surf along on a continuation of this new price trend. However, looking at a larger time frame on the weekly chart, we are presented with a more nuanced trend picture. The medium-term trend on the daily chart may be positive, but the long-term trend on the weekly chart tells a completely different story. It is still red and in strong decline, a negative long-term trend. Now let's go back to the daily chart. As seen, the medium-term bullish trend did not continue and the long-term downward trend was eventually resumed. This next example is also a long trade following a price decline on the daily chart, but with the long-term chart still in a clear upward trend. Trading in the direction of the dominant main trend is of utmost importance in a trend-following strategy. To be clear, this is by no means a guarantee of success, but it is easier to go with the tide than against it. A first important distinction is the choice between a breakout strategy or a retracement strategy. In the first case, you open a long position if price breaks out above a significant resistance level. In the case of the retracement strategy, you take a position shortly after the price rebounds. For both strategies, it remains important that the direction in which you take a position is in line with the current long-term main trend. And which strategy you use is purely personal. One strategy is not better or worse than the other. The actual signals to effectively open a position can occur in a variety of ways. A commonly used method are the buy signals which occur when moving averages cross. For illustration purposes, we will use the 20 and 50 simple moving average. The left-hand chart shows the moment when the SMA 20 crosses the SMA 50 upwards. This indicates that the medium term is changing from negative to positive. As the long-term trend on the chart on the right has remained positive throughout this period, the crossing of the two averages can be seen as a confirmation of the long-term trend and is considered a buy signal. The greatest disadvantage of crossing MAs is that the signal comes rather late. This is logical. Moving averages are, like many other indicators, lagging. After all, they are based on prices from the past. You can slightly reduce this by shortening the period of the moving averages and, for example, instead of using a crossing of the 20 with the 50 SMA, to consider the crossing of the 10 with the 20 SMA. However, the fact remains that such an entry signal is less suitable if the momentum is very high and the share price is rising rapidly. The advantage is that such a signal is very objective. There is either a crossing or there is none. No further interpretation is needed from the trader or investor himself. Technical patterns such as the ascending or descending triangles, head and shoulders, cup and handle are all classic price patterns which, when combined with specific support or resistance levels, can form low-risk setups with which to act in the direction of the existing trend. Technical indicators can also be used to open positions. For example, the relative strength index and the stochastics indicator are oscillators that indicate when a stock is overbought or oversold. The signals given by such indicators are in themselves not reliable enough to be used as actual buy or sell signals. But if only the signals in the direction of the existing long-term trend are monitored, a lot of false signals can be filtered out. It goes without saying that the more of the above elements occur simultaneously, the more reliable the signal will be. So always be very selective when looking for setups and only withhold the best candidates from your list. Finding quality setups among the many thousands of stocks is anything but an easy task. ChartMill, for example, tracks more than 23,000 stocks and ETFs worldwide on a daily basis. Fortunately, the software allows you to quickly and efficiently obtain a basic selection of stocks with which you can get started. So I briefly go over a number of screens from the Trading Ideas page, which can be used as a basis for trend following strategies. The retracement setups, price near SMA 20 and price near SMA 50, these are screens that searches for stocks in a long-term rising trend whose price has a temporary dip near the SMA 20 or SMA 50. Once such stocks are selected, the price formation around that average is examined and we try to detect clear reversal patterns where a relatively short stop loss is possible. The minor price retracement screen using the force index indicator is used to identify temporary pullbacks in long-term rising trends. The force index indicator, developed by Alexander Elder, uses price change in combination with volume to identify the strength of a price movement. The bull flag screen. Positions can also be taken based on technical price patterns. A bull flag is a technical continuation pattern which can be observed in stocks with strong uptrends. The pattern takes shape when the stock retraces by going sideways or by slowly declining after an initial big rise. This screen tries to recognize this specific pattern. In a long-term upward trend, a breakout from such a bull flag pattern is considered as a buy signal. There is a separate video available about the bull flag pattern, from which the link is now appearing on your screen. The breakout screen filter is used to detect stocks which, after a period of consolidation, break out of their existing trading range on heavy volume. And this strategy is used primarily for stocks which have been close to resistance for some time. In any case, the long-term trend must also be positive. You'll notice that there are many other possibilities. You'll have to do some testing yourself to see which combinations of filters give you the best results. The general market conditions play an important role here. A specific filter combination that produces hardly any setups today can suddenly produce dozens of setups tomorrow. So make sure to test enough filter combinations, and over time, together with the experience gained, you will eventually be able to predict which filters in which specific circumstances give good setups. Fine-tune the basic screens and trading ideas to your own wishes and save them in your personal account. Depending on the market conditions, you can quickly switch between your different filter screens to find the best setups. There are some other interesting topics that are important if you want to get started with a trend following strategy, such as what type of orders to use, why money and risk management is so important, and how to protect accumulated profits. Those points are neatly summarized in the article which accompanies this video and of which I already added a link below. Thanks for watching, and don't forget to give us a thumbs up if you liked the video. Trade safe and see you next time. Bye.